All right, you should see a whiteboard in front of you that reads financial planning topic, investment fundamentals, asset allocation. So click the raise hand button if you can see that. That'd be helpful to me. Thank you very much. Let me move this bar. Okay, and this is the part where many people join this. We've been splitting our videos. So we've got financial planning topic by itself on YouTube. So I'm just going to remind you, if you're seeing this on YouTube for the first time, just please hit the like, subscribe, and notification button so that you stay on top of our videos. So this is asset allocation. So you folks all hear about asset allocation. So this is the, these are our investment pie charts. So you're going to see me looking down. I'm just going to draw, you see these on presentations and on your statements all the time. Here are your investments, and you got these pie charts, and there's often some risk tool that's used to develop that. But what does that really mean? How are these things derived? Really, what are these pie charts? How does it work? Well, you know that this is what we call fundamentally asset allocation. Oh, sorry. And this pie chart represents different types of investments. So you might see here large companies. So you'll hear sometimes large growth. So these are large stock companies. The S&P 500, the Dow Jones. Sometimes you see large value. So they're, again, large company. Sometimes these are a blend. Sometimes you'll see large blend. And then you might have mid-sized companies, and you'll hear the term cap. That's capitalization. It just means, how much of the market they have. So mid-sized companies, you might have some smaller companies. You might have some bonds. And, international investments, whether they be international bonds or whether they be international stock. You might have some real estate or other specialized holding. Maybe you got a little bit in precious metals, gold, silver, etc. And other commodities might sit here. But that is, that's how we or that is what's called asset allocation. So, very simply, just having representation in each one of these areas. And we're going to talk as we go through this series. So I didn't mention this in the beginning of the start if you're just joining us on this video, but this is the first of an investment fundamental series. So over the next several weeks, we're going to talk about asset allocation. We're going to talk about active management versus passive management. We're going to talk about risk analysis. We're going to talk about rebalancing. We're going to talk about individual stocks. We're going to talk about individual bonds. We're really going to get into fundamentals of investment management. But today we're going to talk about asset allocation. And we don't want to forget, this is one part of it. You know how I feel about how do we manage these difficult markets? Well, you use asset allocation. Make sure you've got the appropriate amounts in each section there. You also want an appropriate amount in principal protection to make sure that you have a portion that's going to give you some good returns, some modest returns, but some good dependable returns, but isn't going to go below zero in any given year. That helps you from having to crawl out of a hole. So you got to determine how much to put in each one of these. And then we add account segmentation. And that is simply having a game plan or an asset allocation for each time in your life. So you're properly funded. When I was brought up in the pension world in this business, we called it asset liability matching. We do the same for each individual. But today we're focusing on asset allocation only. So you determine how much you have in each one of these pie charts. And then, of course, you got to determine the investments that go into there. And you have to make sure that they're the best investments that are available. And we're going to talk about how we work through that, right? Like, how do we decide what the best large company growth fund is, or the large company growth exchange traded fund? We'll talk about that. But back to general asset allocation, there are two basic ways to manage your allocations. And one is strategic asset allocation. So what is strategic asset allocation? I pulled these definitions from Investopedia. And anybody can do that, investopedia.com. I just Googled it, strategic asset allocation. Investopedia is, I really like that one because it tends to have just simple language, and it simply writes, Strategic asset allocation is a portfolio strategy whereby the investor sets target allocations for various asset classes and rebalances the portfolio periodically. The target allocations are based on factors such as the investor's risk tolerance, time horizon, investment objectives. The portfolio is rebalanced when the original allocations deviate significantly from the initial settings due to differing returns. So strategic allocation is based on modern portfolio theory. And I actually meant to pull down some information about this, but that was a theory that was derived out of, I think, the University of Chicago, if I'm remembering correctly. And I can't remember the person's name, but he won a Nobel Prize for putting this together. So if one of my regular students are out there who knows details about this, if you want to share the person's name who started modern portfolio theory, I'd really appreciate that. But modern portfolio theory basically says you have your level of risk here, and you have your level of return here. And then we have this thing called a capital market assumption line. So capital market assumption line is, not to get too in the details, but different companies have different thoughts on what we should expect along this line. But we choose whichever one fits, and there's not much deviation there, but it's just what should the growth be, during this, and that changes from time to time. But strategic asset allocation says for a given amount of risk, you get a certain amount of return. So these portfolios sit on this capital market assumption line. And of course, if our returns start here at 0 and your risk start at 0, and let's just say it goes to 10 and the return go to 10, just to keep it simple, well, you can see this is going to be a heavy cash, maybe, a third or a half, kind of a principal protected or very conservative. So I don't want to use principal protection because it's a little different. This will be your most conservative portfolio over here, because you're probably at like a 2% return for a 2% risk here. And then as you go further out on here, let's just say you're at a 4 and a 4, and it's not, these aren't the exact numbers. I'm sharing very basic fundamentals with you. So you see, as you get more riskier, right, you get a higher return. So more risk here, higher return here, right? You take more risk, go closer up on the scale, and this would be your riskiest portfolio. Now it can go higher than that, of course. You can go all the way up if you're assuming a much higher rate of return. Just depends on your structure. But that's the basic of strategic asset allocation. And most people pick one. Most investment advisors, they'll say, okay, your risk tolerance says we shouldn't be invested this way, so we're going to create this portfolio for you. And then they'll create this portfolio, and they'll choose those components that we talked about on the other side, and they'll say that we're going to keep this rebalanced to make sure these components, say if 25% of this should be in the US stock market, and it goes up to 30%, then we're going to rebalance this portfolio and bring that back down to 25% to make sure that things don't get out of whack. And that helps, that structure of rebalancing helps, your volatility. It's been shown it helps minimize it, right? So you might get a little less volatility there. I don't know what that's about. And get to the same place just using rebalancing. So again, that's one step in our allocation. But that's how that works, and that's what strategic asset allocation is based on. It's based on modern portfolio theory, and just remember that for the given amount of risk, if your portfolio is constantly rebalanced, you get a certain amount of return. Now, constantly is different for each type of account. With a retirement account, you might default to every 3 months, you rebalance that. With a non-retirement account where you've got some capital gains tax to be concerned about, that might be a yearly rebalance. So that is strategic asset allocation. Now let's talk about tactical asset allocation. Now, tactical asset allocation is often part of strategic asset allocation, but it can sit by itself. Tactical asset allocation is an active management portfolio strategy shifts the percentage of assets held in various categories to take advantage of market pricing anomalies or strong market sectors. This strategy allows portfolio managers to create extra value by taking advantage of certain situations in the marketplace. It is moderately active. It is a moderately active strategy since managers return to the portfolio's original asset mix once reaching the desired short-term profits. I don't know if I agree with that part of it. I mean, I guess fundamentally that might be the correct definition. I do find that active managers tend to get very active and stay that way. So I tend to lean more on, I can't find my cursor here, more on strategic asset management instead of tactical, or tactical asset management. But it doesn't mean I won't choose a manager for one of these pie charts, these sections of your pie pieces that has a tactical tilt. So usually these tactical allocations won't deviate more than say 5% to 10%, but they might say like BlackRock has a tactical management division, right? So they do strategic asset allocation. They also do tactical. So they might say, and you've heard me say it, you know, we're overweighting bonds right now. So if you're going back to this here, let's just say this holding here of bonds is supposed to be 30%. Well, BlackRock might say, we're going to take this up to 40% in the time being. This is not a recommendation. I'm not saying that's what you should do, or that's what they're doing. I'm giving you an example. And then 6 months from now, they might say, okay, we're underweighting bonds to 20%. So they're looking at things in the market and they're making adjustments to see where they should place their money to give incremental advantages. And it's not just bonds. It could be done anywhere. They might say small companies, small US companies, we think are going to outperform. So if there's a 5% rate weighting in here, we're going to take that to 7, you know, or they could take it all the way up to 10. You know, it's really subjective to what the managers and any investment manager can make any changes they want in their portfolio. So that's how tactical asset management works. As a whole, I've found in my career, my opinion only, that the risk, the additional risk that you take by moving things around outside of this strategic asset management model as a whole don't typically pay off. And a really good example is BlackRock overweighted international stocks coming out of the pandemic because they thought that European structure, the EU, the European Union, and the European structure was going to come out of the pandemic much stronger than the US, and they were completely wrong. It was the complete opposite. There is also out there thematic investing. So thematic investing says, okay, this is what these are the areas of the market. It's kind of much deeper than tactical. These are specific areas of the market where we're going to invest our money. You know, a big one was infrastructure, roads and infrastructure. Yes, we need to spend a lot of money on roads and infrastructure, but that's really tied to government programs, and there's a lot of risk there. But you know, there was an investment manager when I started at UBS that was one of the best managers, won the best manager award for 10 years prior to my time starting there. And he was a thematic investor. And I'm really fortunate that I learned this right in the beginning, because you know, we had the dot-com. So I started in 2001. We had a dot-com issue. We had all the issues with accounting, right? Where you know, Enron and CEOs getting arrested and charged. So it was almost like someone went through his thematic weightings and investments and just checked off each one of them. We're going to hit this, we're going to hit this, we're going to hit this, and just obliterated his portfolios. So in my opinion, you just don't want that. In my opinion, you want, I lean on strategic asset allocation. I will implement a manager like a tactical manager within these portfolios, but not as a whole. I see a question here. Gerard, does the Roth bucket inherently take on more risk since it would be the last place to take funds, hence longer time horizon? Not necessarily. So this is off topic a bit, but let me address it. So what Gerard is saying, if you know you're focused on your investment buckets and how do you invest those, you have your taxable bucket tax deferred, and tax-free. And we know we have a mathematically ideal amount that we want in each one of these buckets. Here we want 6 months to 1 year of expenses. In your tax deferred, so they're your IRAs and retirement plans. You want an amount that, if you can, an amount that generates a required minimum distribution that's below your standard deduction. So that can come out tax-free, but for everybody that's different. So it could be a span of $0 to $500,000, depending on the individual. And then everything else we want to push over to this tax-free, because anything out of tax-free, anything that comes out of here, you pay 0 tax as long as it's set up correctly. And the only things that are truly tax-free are Roth IRAs and properly structured cash value life insurance. So, and I guess you could throw in there health savings accounts, but there are some requirements on how you spend those. So Gerard asks, shouldn't Roth sit here and be most aggressive, right? I think that's what he's asking. Does the Roth IRA bucket inherently take on more risk? It would, since it would be the last place to take the funds, hence longer time horizon. So could be. We have plenty of folks that start drawing their funds out of the Roth IRA in 5 years, right? It could be. It all depends on the situation. You don't always wait until 10 years, 11 years, or that being the last place to draw funds from. You might be in a situation where you're drawing funds from your IRA and you're drawing funds from your Roth IRA, because it's about balance. There's nothing wrong with it. So it all depends on the individual, just like everything. Some people never draw from the Roth IRA. Some people just say, okay, I'm going to leave it there in case I need it. I'm going to pass it on to my heirs. I want it to be tax efficient. And that's fine too. So it depends, Gerard. But it's really important to get these allocations right. And then it's really important to put these portfolios that you develop on these on this line here in the right places. Because if you invest here, even, let's not go fully aggressive here. I'm here. Let me see. I don't like these pen colors, the way they changed them, but let me try to use it, make things a little clearer. So I like green. Let's do green. All right. So if you invest here, and let's just say that's your typical 60-40 portfolio, and that actually might be more like here. And you've got all your money in there, and I kid you not, people do that all the time. In fact, the majority of people do that. And you're counting on that to fund this year, next year, following year, and all the way to retirement. And you're down 10%. You're taking money out of portfolios that are down 10%. You're never going to see a recovery of that. So you got to be really, really careful, and you could be down 20%. You could be down 30%. You could be down 40%. It happens. And we're going to have some challenging market times. So you got to be really careful where you got to develop these portfolios, put them together properly, keep an eye on them, monitoring. We're going to talk about those as we go through this series. Rebalance, we're going to talk about that. But you got to be really careful where these flow and sit on your timeline. So great question, Gerard. I thought it may not have been applicable, but it certainly was, as it always is. I appreciate that. Well, folks, as always, I hope this was helpful. So we talked about a lot of great headlines today, some stuff to pay attention to. We went over our financial planning topic today, investment fundamentals, asset allocation. It's going to be the beginning of a series over the next 4 or 5 weeks. I hope you join us, not next week, but the following week as we continue with this. And I hope this was helpful. If you have any questions, reach out to me. If you want to schedule time with me, you can send me an email or schedule time. You should see a calendar. Actually, no, you'll get a survey at the end of this webinar. Let me know what you think. Let me know what other topics you might want to cover. I always love hearing your feedback. Have a great day, and we'll see you in a couple of weeks. Take care.